Assalamualaikum and hello everyone. We are from group chapter 13 are going to present about control of treasury operations. This is the list of presenters in the group. Name Nurul Ain binti Sazali, Nur Izzian Kamilah binti Abdul Khalid, Afifah binti Jumaat, Sahira binti Abdul Anwar, and Muhammad Safwan bin Suhaimi. There will be 5 topics that is covered in the chapter. That is counterparty limits, daily limits, B&M reserve requirement and liquidity framework, segregation of daily room and back office function, and other miscellaneous controls. I will be the first presenter. My name is Nur Izzian Kamilah binti Abdul Khalid, matrix number 261418, and I will present about counterparty limits. Counterparty limits are set by an entity to manage and control its risk. Counterparty limit restricts the risk exposure to a particular counterparty. There is 2 types of counterparty limits, that is pre-settlement risk limit and also settlement risk limit. Face-out limit is the possibility that one party in a contract will fail to meet its obligation in contract, resulting default before the settlement date. While settlement risk limit is the possibility that one or more parties will fail to deliver on the terms of contract at the agreed upon time. Next is what is pre-settlement risk. Just like I said earlier, pre-settlement risk is the possibility that one party in the contract will fail to meet its obligation under the contract, resulting in default before the settlement date. This default by one party will prematurely end the contract and leave the other party to experience loss if not insured in some ways. A risk of this type can additionally lead to replacement cost risk as the injured party must enter into a new contract to replace the old one. Terms and market conditions may be less favorable for the new contract. So if we talk about contract, there must be risk. The pre-settlement risk is more like a concept than a variable cost. This risk is much more applicable in derivatives such as forward contracts or swaps. For example, future transactions partially spread this risk across the clearinghouse fees levied through the exchange. All parties need to consider worst-case loss that might occur if a counterparty defaults before the transaction settles or becomes effective. For example, Sun Company formed a contract in the foreign exchange market with Shan Company to swap US dollars for Japanese yen in 2 years. If before settlement, Shan Company goes bankrupt, it will be unable to complete the exchange and must default on the contract. Assuming Sun Company still want or need to enter such a contract, it will have to form a new contract with another party, which lead to replacement cost risk. We must remember that pre-settlement risk exists in theory for all securities, but trade in equities that last for a short duration. Next is, what is settlement risk? Settlement risk is the possibility that one or more parties will fail to deliver on the terms of a contract at the agreed upon time. Settlement risk is type of counterparty risk associated with default risk, as well as with timing difference between parties. Settlement risk is also called delivery risk or hashtag risk. This risk is very similar in securities markets. Settlement risk is simply that the chance that a buyer or seller fails to keep their end of deal. There is risk for anyone buy goods online that the goods will show up late or never arrive. But unsurprisingly, settlement risk is usually nearly non-existent in security markets. Settlement risk has historically been an issue in the foreign exchange market. The creation of continuously linked settlement (CLS) helped to improve the situation. CLS is facilitated by CLS Bank International, eliminate time difference in settlement and is considered to have provided a safer forex market. So there is 2 types of settlement risk. The first one is default risk. Default risk is the possibility that one of the parties fails to deliver on the contract entirely. This situation is similar to what happens when an online seller fails to send the goods after receiving the money, just like I said earlier. Next is settlement timing risk. Settlement timing risk include potential situations where securities are exchanged as agreed but not in the agreed upon time frame. Settlement risks are generally far less serious than default risk as transactions still take place. Hashtag risk is the real-world example of settlement risk. The case of the collapse of Hashtag led to the creation of the Basel Committee on Banking Supervision, consisting of representatives from both central banks in the regulatory authorities and the Group 10 G10 nations. That's all for me. Thank you.
Hi, my name is Nurul Ain binti Sazali and my matrix number is 255898. I will explain about dealing limits. Dealing limits allow clients with valid framework agreement to flexible make use of hedging operations without the need of blocking funds. Each person should also have his own deal limits, restricting the size of individual transactions and types of financial instrument he can deal over a period of time. Deal that exceeds the limits or involve alternative financial instruments will require an additional layer of approval or authorization. Next will be the bank dealers' activities in money markets trading. Bank dealing in money markets instruments are subject to a number of legal restrictions. Now we focus on their activities. The first one is the federal funds. Dealers' bank provide federal fund clearing service to their correspondent bank. Furthermore, service contract does not specify maturity and amounts and does not require advance notice for terminations. The interest rate on such a contract is adjusted daily. Second one is bankers' acceptance. Bankers' acceptance are an obligations of the acceptor bank and indirect obligations of the drawer. Bank deals the maturities generally less than 9 months. Next one is certificates of deposits. Banks should attempt to minimize market risk by establishing a maximum holding limit to dealers for each class of money markets principal. Then, the policy guidelines also should establish concentrations limit for money market instruments issued by single obligor. The last activities is offsetting repurchase transactions. Dealers' banks involve resale and repurchase agreements. They also limit the aggregate amount of reverse repo and repo accounts. Moreover, specify acceptable amounts of funds for unmatched or extended maturity transactions. Last but not least, these activities determine maximum time caps for unmatched maturity transactions and minimally acceptable interest rate spreads for various maturities agreements.
Hi, I am Sahira binti Abdul Anwar and my matric number is 26406, and I'm going to continue the presentation with the BNM's reserve requirement and liquidity framework. First of all, we need to understand what is reserve requirement. Reserve requirement is the amount of cash that bank must have in their vaults or at the closest Federal Reserve Bank. Federal Reserve Banks mean in Malaysia is our central bank, negara Malaysia. Bank loan funds to customers based on a fraction of the cash they have on hand. The government makes one requirement of them in exchange for this ability. They must keep certain amount of deposits on their hand to cover possible withdrawals. This amount is called reserve requirement, and it is not the rate that bank must keep in reserve and are not allowed to lend to the customers. Bank Negara Malaysia had announced that the MGS, which is the Malaysian Government Securities, and MGII, which is the Malaysian Government Investment Issues, can be used by banking institutions to fully meet the statutory reserve requirement (SRR) compliance effective 16 May last year. This flexibility is available until this year's 31st May. These measures will release approximately 16 billion worth of liquidity into the banking system. The SRR ratio remains unchanged at 2%. This measure is part of PNM's continuous effort to ensure sufficient liquidity to support financial intermediation activity. The SRR is an instrument to manage liquidity, and it is not a signal on the stance of monetary policy. The overnight policy rate (OPR) is the sole indicator used to signal the stance of monetary policy and is announced through the monetary policy statement released after the Monetary Policy Committee meeting. Next is the liquidity framework. It is introduced in 1998 to enhance the liquidity management in the banking system in Malaysia. This framework is introduced in order to replace the old liquid asset ratio requirement. The reason why this framework is established is to create awareness among the banking institutions of their funding structure and their ability to handle short to medium-term liquidity problem. Next is to adopt a more efficient and ongoing liquidity measurement for banking institutions in Malaysia. Last but not least, to provide BNM, Bank Negara Malaysia, with a better means of assessing the present and the future liquidity position of banking institutions. The broad concept of the liquidity framework is that it focuses on the ability of a banking institution to match its short-term liquidity requirements. The projection is up to 1 year of the maturity profile of a bank's asset, liabilities, and off-balance sheet commitments. Basically, it has 3 levels. The first level is to measure the sufficiency of a banking institution liquidity. The second level is to see whether or not a banking institution has the capacity to withstand liquidity shocks. And the third level, the last level, is to measure the banking institution general funding structure to assess the degree of dependency on certain non-volatile market. Now, we will focus on the liquidity measurement, which is the first level. The first level of the liquidity measurement provides a maturity ladder profile with 5 maturity bands beginning from up to 1 week for commercial bank, up to 3 days for investment banks, to a 6 to 12 month band for both commercial and investment banks. The primary basis for determining the appropriate time bands is the contractual maturity, which is when the cash flows crystallize. As a guide to banking institutions, the BNM provides a list of recommended treatment to arrive at the behavioral maturity of loans, deposits, and undrawn commitments. The objective of this first level liquidity assessment is to arrive at a projected net maturity mismatch profile of a banking institution stretching from 1 week for commercial bank, 3 days for investment banks to 1 year. Now, for the second level liquidity management, at this level, the focus of assessment is whether a banking institution has sufficient liquidity surplus and reserve to sustain a sudden liquidity withdrawal shock arising from a banking institution specific crisis. The liquidity measurement at this level takes into account the additional emergency funds that can be quickly realized from the sale of liquidable asset, which is that it brings forward their maturity date or drawn upon from formerly available credit lines. Banking institutions should be able to sustain heavy withdrawals up to a period of 1 month. To test the banking institution's ability to withstand the crisis, the adjusted maturity profile is then compared with the potential amount of heavy withdrawals that can take place during a crisis. The actual quantum varies from one banking institution to another banking institution depending on their funding structure and will be method to be agreed between Bank Negara Malaysia and the banking institution on a case-by-case basis. For the last level, which is the third level, it consists of series of broad ratios and supplementary information designed to indicate the extent of which a banking institution is dependent on a particular market for its funding sources. The coverage includes large customers' deposits, interbank market, and offshore market. This information will allow the banking institutions to assess the its exposure to liquidity risk in the event of disruption in the relevant market.
Assalamualaikum warahmatullahi wabarakatuh. My name is Arifah binti Jumaat, metric number 263900. I'm going to present about the segregation of dealing room and back office function. Dealing room. Dealing room is an area within the bank responsible for purchase and sale of currencies and the management of the bank funds. This is where the OTC trading in the financial markets take place. It is a hectic environment with dealers surrounded by screens and telephone. A dealing room function is to enclose space apart from the public and secreted from other departments. In this section, there is a brief rundown how the dealing room operates, the dealer's responsibility, and the dealer's desk. Dealing room consists of money desk, foreign exchange desk, derivative desk, and customer desk. Back office. It refers dubious transaction to manager, process transaction, and dispatch payment or receive instruction. It must be a discrete operating unit from the dealing room. The basic back office function are to process all deals done by the dealer. This involves obtaining independent verification of deal details directly with each counterparty and making any settlement as required. Ensuring a confirmation is dispatched and received for each deal struck. This is where the processing, confirmation, settlement, query handling, and cash management function are carried out. It is important to remember that dealers cannot trade without the back office. The back office operations are also involved in numerous other control functions and often provide management information support to the dealers and treasury managers. It consists of verification, confirmation, books, and settlement.
Assalamualaikum warahmatullahi taala wabarakatuh. My name Muhammad Safwan bin Suhaimi. My metric card number 265125. I am the presenter 5 to present about the others miscellaneous control. Others miscellaneous control is have the small scope. Is it treasury control? So the sound treasury controls can prevent our company losing money and its reputation, argues with Penny. So what type treasury control? It has the 9 types treasury control. First, include treasury control in about policy, gap management, help for treasury strategy to ensure that the risk and answer are known. Second, from back office separation, dividing tasks in a financial form a regulations operation. Third, delegation of authority. Make sure your decision making and power are correct. Fourth, segregation of duty. This further enforce control on purchases beyond a front back office division. In number 5, automation straight through processing. The fewer opportunities for a mistake are better automation. In the number 6, catch it quickly. The earlier you get a mistake, the more straightforward it is to regain capital and the less likely the markets will be. The value of timely reconciliation is underlined here. In number 8, involve senior management. The Treasury committees encourage differing opinions to be expressed and personal danger to be minimized to a minimum. So in number 8, make it simple for the counterparties. The simpler you make it, the fewer errors there will be. In the last point, zero tolerance for any breach of procedure and control. That's all from me. Thank you.